So, you want to own a parking garage. It is the most unglamorous thing on this channel, and that is exactly the appeal. No customers to charm, no inventory to spoil, no staff drama at 11 at night. A concrete box on a good corner, 6 levels of it, and a small illuminated sign showing a number that goes up by $1 every few years. Cars go in, cars come out. Somewhere a machine takes the money. You never have to be there. You have found the closest thing in the physical world to a bond that you can drive to and touch. That picture is not entirely wrong. Except, before any of that, you have to reckon with the fact that the most valuable thing you own is not the garage. It is the ground it is standing on, and the garage is what is stopping you from using it. Before we go further, we should be honest about who you is here, because a new 400-space structure costs somewhere between $14 and $15.5 million to build before you have bought a square foot of land. And even a tired 180-space deck in a secondary market is a 7-figure purchase with a bank attached. If that is not you and it is not me, then what follows is not a plan. It is a look at how a certain kind of money thinks. And the answer is stranger than you expect. Here's the number that stops you. The national median construction cost for a new parking structure in 2025 was $31,000 per space, according to WGI, which has been running this survey since 2006. That figure does not include the automatic fire suppression that code now requires, which the same report puts at another 15 to 25%. So a 400-space garage is roughly $14.25 to $15.5 million of concrete, and the land is extra. That same figure was $20,450 in 2018. It has risen 47% in 7 years, faster than almost anything else you could have built. And what do you get for it? On the numbers we will walk through shortly, that garage produces somewhere around $1,050,000 of revenue a year. Nobody knows this because the fantasy is unusually good at hiding it. Parking looks passive and passive looks cheap, and the arithmetic of a $15 million building generating $1 million of gross revenue is the sort of thing you only do after you have already fallen in love. The market itself is not helping. IBIS World puts United States parking lots and garages at $13.6 billion in 2025, and that number went down by 0.5%. Their 2026 figure is $13.1 billion, down another 3.7. There are 7,783 businesses in the industry, and that count is also shrinking. This is not a growth market, and it has not pretended to be one for some time. Which brings us to the one concept that outsiders have never heard, and insiders never stop talking about. It is called a covered land play. The idea is that in a central business district, parking is close to the least valuable thing you can legally do with a parcel. As Mike Manville of UCLA's Luskin School put it to CoStar, parking is one step up from leaving the land vacant. So the parking income is not really the investment. The parking income covers the property taxes and the insurance and the carry while you wait for the neighborhood to become worth something, at which point a developer knocks on your door and you sell them the dirt. The income is the cover. The land is the play. Forbes Real Estate Council describes this openly as the strategy of the sector, and Air Garage, which values these assets for a living, notes that an urban lot may be bought entirely for redevelopment potential, with the parking cash flow treated almost as an afterthought, which is a genuinely elegant idea, and it is why a surface lot is such a beautiful asset. A surface lot is asphalt, a sign, and a payment app. When the developer arrives, you scrape it and cash the check. Now, hold that thought because we are about to build a 6-story concrete building on top of it. Start with the costs. The shocking variable is the one nobody budgets for correctly, and it is not construction. It is what the structure costs you every year, simply to remain a structure. And the industry cannot agree on the number within an order of magnitude. ECS, an engineering firm that performs parking structure assessments, budgets annual maintenance and repair at 10 to 30 cents per square foot, which they translate to $30 to $90 per parking space per year. A 2016 conference handout from the National Facilities Management and Technology Show says $30 to $35 a stall. Both of those are trivial. But US-made Supply, writing in 2026, says budget 2 to 3% of original construction cost annually for structural maintenance alone. And at $30,000 a space, that is $600 to $900 per space per year. That is not a rounding difference. That is a 20-fold gap on the single line item that determines whether your building is standing in 15 years. Both sources are contractors selling services, so read them accordingly. But the physical logic runs one way. A parking garage is the only building type you would ever design that is open to the weather on every side, and then deliberately have people drive road salt onto every surface of it. Deterioration runs 2 to 3 times faster than an enclosed building of the same materials. Chloride works into the concrete, reaches the rebar, and the rebar rusts and expands and pushes the concrete off from the inside. That is spalling, and repairing it runs about $75 a square foot. Restoration Systems reports that a comprehensive restoration of a 500-space garage lands between $3 and $7 million against a $14 to $17 million replacement cost. And that patch repairs typically buy you about 5 more years. In April of 2023, a garage built in 1925 on Ann Street in Manhattan partially collapsed. It killed 1 person, injured 7, and prompted the city to order examinations of garages citywide. Then, the ordinary costs. Labor is genuinely cheap by any other industry standard, which is the one thing the fantasy gets right. Labor Statistics wage data for May 2024 puts parking attendants at a median of $16.63 an hour, $34,600 a year. And you need perhaps 3.5 full-time equivalents to keep a 400-space garage covered. Call it $150,000 all in. An operator like LAZ or SP Plus will run the thing for you for a fee, often around 5% of gross, which is $52,500. Insurance, utilities, security, elevator servicing, the payment hardware and cleaning is another $120,000. And I want to flag that last figure as an estimate rather than a sourced one. Property taxes I have deliberately left out because they are jurisdiction specific and they will change every number that follows. Now, the compression, and it is unlike anything else on this channel, because a parking garage has essentially no cost of goods sold. You are selling air above concrete. The marginal cost of the 400th car parking today rather than not parking is a few cents of electricity. Your gross margin on the product approaches 100%. A grocer works on 25 to 30. A software company celebrates 80. You are above both of them, and you are selling nothing at all. So, where does it go? Take our 400-space garage, 250 monthly parkers, at $200 a month is $600,000 a year. The remaining 150 spaces running transient at 55% weekday utilization and a $22 average ticket add $453,000. Just over $1,050,000 of gross revenue on a near-perfect gross margin. Take out labor, the operator fee, insurance, and utilities, and put in maintenance at the friendly ECS number of $90 a space. Net operating income of $691,500. That is a 66% operating margin, which is a spectacular business. Now change one line, use the 2% of construction cost figure instead, $248,000 a year. Net operating income falls to $479,500. Here's the part that catches most first-time owners off guard. Parking assets trade somewhere between a 5 and a 10% cap rate. At 8%, that first version of the building is worth $8,600,000, and the second version is worth just under $6 million. Same building, same tenants, same revenue. $2.5 million of value, decided entirely by which maintenance number you believe, on a line item most buyers reserve nothing against. And now, the failure rate, which is where the folklore is wrong, in the usual direction. There is no 90% of businesses fail here, and there never was. Business Employment Dynamics Table 7 tracks every establishment cohort since 1994. For other services, the sector that contains parking, the 1994 cohort had 51.7% still trading after 5 years and 35.2% after 10. The 1995 cohort came in at 52.2 and 35.8. Roughly half make 5 years, about a third make 10. That is not a scare statistic designed to talk you out of anything. It is an honest description of a sector with a long, slow attrition rather than a cliff. But a garage does not fail like a restaurant fails. Here is the killer. Go back to the covered land play and notice what happens when you apply it to a structure instead of a lot. Our 400-space garage costs $12,400,000 of construction and produces $691,000 of net operating income on the optimistic maintenance assumption. That is a 5.6% return on cost before you have bought the land, before property taxes, into a market that values the finished asset at 5 to 10%. Which means that on a new build in most markets, you spend $12 million to create something worth roughly $12 million, and then you pay for the ground separately. The standalone private for-profit purpose-built parking garage does not pencil. That is why almost nobody builds one. Garages get built by cities using tax-exempt debt, by hospitals, by airports, by universities, and by developers discharging a parking minimum they never wanted. Practically none get built by someone who simply wanted to own a parking garage. And it gets worse, because the concrete does not merely fail to pay for itself. It actively destroys the thing that made parking attractive in the first place. The surface lot's whole beauty was optionality. When the land is finally worth more as apartments, you scrape it and sell. The garage takes that away. Now the developer is not buying a clean parcel, they are buying a demolition job, with a parcel underneath it. Columbus condemned a 650-space garage and spent $750,000 replacing it with a 180-space surface lot because a hole with cars in it was worth more than the building. St. Joseph, Missouri is currently removing the upper levels of 2 downtown garages that deteriorated past the point where repair made economic sense. Binghamton, New York is tearing down a garage from 1970 and relocating the monthly parkers. So the reframe is this. You did not buy a covered land play. You bought a land play with $12 million of concrete sitting on top of it, and every year the concrete gets more expensive to keep and more expensive to remove. Meanwhile, Moody's Analytics has national office vacancy at 21% in the first quarter of 2026, a record against 17% in 2020. And the monthly commuter, who was your one reliable customer, is now coming in 3 days a week. So let us run the actual numbers on 2 realistic versions of your parking garage. Option 1, the modest version. You buy an existing 180-space deck in a secondary market rather than building anything. 110 monthly parkers at $160 a month is $211,000 a year, and 70 transient spaces at 50% utilization, and a $16 ticket at $140,000. $351,000 of gross revenue. Labor and automation, $65,000. Operator fee, $17,500. Insurance, utilities, and technology, $60,000. Structural reserve at the friendly number, $16,200. Net operating income of $192,000 before property tax, at an 8.5% cap rate. That building is worth $2,260,000. Lenders treat parking as special use, so you're financing perhaps 60%. $905,000 of your equity, $1,357,000 of debt, and interest at 7.5% takes $101,000 a year. You clear about $90,000, which is a 10% cash-on-cash return. That is a good number. It is also a number that one spalling repair on one deck erases for 2 years. Option 2, the premium version. You build the 400-space garage for $14.25 million, all in, and you run it well. $691,000 of net operating income, a 66% operating margin, and a 5.6% yield on cost before you have paid for the land. It is a genuinely attractive business on paper and a brutally hard business in practice. And the honest verdict is that the only reason to build it is that you own something else nearby that needs it. The parking business works. It works because cities concentrate people, and people arrive in cars, and storing a car near a valuable place has been worth money since the invention of the valuable place. It does not work the way the fantasy version suggests, which is a concrete box that quietly prints money while you do nothing. It works when you already own the land and bought it cheaply. It works when the structure is a cost of doing something else and the something else is the business. It works when you're running the deferred maintenance schedule, and your competitor is not. It works when the neighborhood is about to turn and you're the one holding the corner. It works when you understood on the day you signed that you were buying dirt, and the building was the price of admission. Not bad, for an industry whose entire product is empty space.